Friends, thank you for being here today. I want to talk to you today about the unwinding, a critical story involving Japan liquidity and the coming global financial reset that affects every single one of us. What if I told you that the invisible financial force that has kept your mortgage cheap and your stocks high for decades has just vanished? And how would you prepare if you knew that the greatest transfer of wealth in history wasn't coming in the distant future but had already begun? To understand where we are going, we first have to look back at a structural shift that is marking the end of an era for the silent giant of the global economy. For 3 straight decades, the global financial system has rested upon a foundation that few average citizens noticed. But every major financial institution relied upon the economic policy of Japan. Often characterized as the silent giant, Japan has functioned as the world's monetary printer, maintaining a unique economic environment that rippled across every ocean and into every portfolio. The core of this era was defined by a specific unwavering strategy, a zero interest rate policy that persisted through booms and busts alike. This policy created a distinctive financial ecosystem where Japan borrowed at basically zero cost, printed endless amounts of yen, and acted as a fountain of cheap liquidity for the rest of the world. The scale of this operation is difficult to overstate. By keeping domestic rates suppressed, Japan encouraged the export of capital. Investors and institutions finding no yield at home sent their money abroad. Specifically, Japan shipped trillions of dollars overseas, injecting approximately $3.3 trillion into United States Treasuries alone. This massive inflow of capital had a specific distorting effect. It kept interest rates artificially low everywhere else. If an American homeowner enjoyed a cheap mortgage in the 2000s, they could in part thank Japan. If stock market multiples reached sky-high valuations, investors could thank Japan. If governments around the world borrowed like drunken sailors with seemingly no immediate consequences, they too could thank the silent giant for absorbing the debt. However, earlier this month, the silent giant pulled the plug. The era of the invisible bid that propped up the developed world for a generation is vanishing in real time. The signal for this seismic shift was a single stark number. Japan's 10-year government bond yield punched through 1.7%. While this figure might seem modest compared to American rates, in the context of the Japanese economy, it is a thunderclap. It represents the highest level since 2008. Music. That single data point effectively ended the greatest carry trade in financial history, signaling that the structural dynamics of global finance are snapping. Japan is now facing a bond market meltdown that threatens to upend the status quo. The nation is the most indebted major economy on Earth, burdened with a debt-to-gross domestic product ratio of roughly 263%. This means the Japanese government owes more than 2.5 times the total value of everything the country produces in a year. For years, the only reason this mountain of debt was sustainable was because the interest payments were negligible, but at one point, 7%, the math changes violently. Japan's annual interest bill is set to jump by an extra $27 billion a year. The situation is further complicated by political maneuvering. Japan's new prime minister recently signaled that the country was gearing up to issue a massive stimulus package, roughly $110 billion, because the economy cannot survive without it. But the bond market finally said no. Investors, dubbed by traders as the techie trade, are betting that yields will continue to rise because the government must issue a new wave of long-term bonds to fund this spending. As more supply hits the market, investors demand a higher yield to be compensated for the risk. This leaves the Bank of Japan in a trap from which there is no easy escape. If they print more yen to buy their own bonds and cap yields, they risk crashing the currency. But if they step back and let yields continue to rise, the cost of servicing their massive debt becomes ruinous. No central bank or nation has survived this level of debt for long without facing either an outright default or hyperinflation. Now you might be asking, how does a shift in Japanese bond yields threaten the entire global system? To answer that, we need to dive into the mechanics and the collapse of what is known as the yen carry trade. To understand why a rise in Japanese bond yields threatens the American stock market and global stability, one must understand the mechanics of the yen carry trade. This strategy has been one of the largest invisible global financial trades for decades. Fundamentally, it is an interest rate arbitrage play. The premise is simple. An investor borrows money in a currency yen trade collapse with very low interest rates, historically the Japanese yen, and invests that capital in assets denominated in a currency with higher returns such as the United States dollar. For years, investors would borrow cheaply in yen, thanks to Japan's near-zero rates, and then deploy that capital abroad. They bought United States Treasuries, corporate core rate bonds, real estate, and in more recent years, speculative assets like cryptocurrency and high-growth technology stocks. It was a can't-lose trade as long as two specific conditions remained steady. Interest rates in Japan had to remain near zero, and the yen had to remain weak relative to the dollar. Borrow long in yen, earn a higher rate, earn elsewhere, and pocket the difference. But now the foundations of this trade are cracking. The recent spike in Japanese yields has begun to unwind this massive leveraged web of capital. As yields rise in Japan, the incentive for domestic Japanese investors, insurers, pension funds, and banks to hunt for yield overseas diminishes. If they can earn a decent return at home without the currency risk, they will bring their money back. This process, known as repatriation, sees a flood of capital leaving foreign markets, including the United States Treasury market, and returning to Japan. Furthermore, there is a pervasive fear in the markets that the Bank of Japan will be forced to raise interest rates officially to combat rising inflation and stabilize the currency. If the central bank hikes rates, the yen strengthens. A stronger yen is the kryptonite of the carry trade. Because these trades are often highly leveraged, even a small increase in the value of the yen makes the loan significantly more expensive to pay back. If an investor borrowed 100 million yen when the currency was weak and suddenly the yen surges in value by 10%, that investor now owes significantly more in their home currency terms to close out the loan. This dynamic creates a forced deleveraging event. Investors are rushing to pay off their yen-denominated debts before the currency strengthens further or rates rise higher. To generate the cash needed to pay off these loans, they must sell the assets they purchased with the borrowed money. This leads to selling pressure in United States stocks, bonds, and crypto assets that seemingly comes out of nowhere. It is not necessarily because the fundamentals of those assets have changed, but because the source of funding used to buy them is drying up. We witnessed a preview of this volatility in August of the previous year. When the yen started to strengthen and the Bank of Japan hinted at policy changes, the ripple effect was immediate. Tech stocks suffered and Wall Street whispered about a potential Black Monday. While markets eventually stabilized, it was a warning shot. The current rise in yield suggests that the next unwind could be structural and far more prolonged. Traders are now trying to front-run this event, selling assets now to avoid being caught in a crowded exit later. This preemptive selling is creating a liquidity drain that is acting as a gravity well on asset prices globally. But this isn't just a problem for Tokyo. The contagion is already spreading to United States markets, creating a severe liquidity crisis. The consequences of Japan's shift are not confined to the bond market. They are manifesting as a contagion in United States equities and private credit. Recent volatility in major technology stocks provides a clear case study. NVIDIA, a bellwether for the artificial intelligence boom and the broader market, recently experienced a massive decline with its stock tanking 9% intraday. This move evaporated nearly $500 billion in value in a vanishingly short period. The Nasdaq 100 followed suit, swinging from positive gains to a crash of over 4% in a single day. While some analysts point to specific company fundamentals, the speed and severity of the sell-off suggest a deeper liquidity issue. When liquidity, the availability of cash or easily convertible assets, dries up, high-flying stocks are often the first to be sold because they are the most liquid and have the most profits to protect. However, there are also specific concerns regarding corporate health that are exacerbating the fear. There have been discussions regarding Nvidia's financial statements, specifically concerning increases in finished goods, accounts receivable, and complex relationships with entities like CoreWave. When combined with heavy insider selling, such as the chief executive officer completing a significant sale of shares just prior to a market top, it creates an atmosphere of anxiety. But the rot goes deeper than public equities. There is a liquidity hell unfolding in the private credit sector, a corner of the market that has grown exponentially in recent years. Private credit involves non-bank institutions lending directly to companies. As traditional liquidity tightens, cracks are appearing in this opaque market. We have seen a string of disturbing events where credit lines are US liquidity crisis frozen and companies collapse overnight. For instance, Tricolor, a company in the auto finance space, essentially collapsed after JP Morgan froze a warehouse line of credit worth over $700 million. It was a rug pull that signaled banks are becoming terrified of risk. Similarly, First Brands faced issues with auditors and financing leading to its collapse. In the real estate sector, Renovo Homes, backed by BlackRock, went from valuing its assets at 100 cents on the dollar to 0 cents on the dollar virtually overnight. Five Star Development, a Ritz-Carlton developer, went bankrupt after a $30 million loan was pulled. These are not isolated incidents. They are symptoms of a systemic liquidity drought. When credit lines are cut, businesses that rely on debt rollover to survive are instantly insolvent. Cryptocurrency, often touted as an uncorrelated asset, is currently behaving like a canary in the coal mine for global liquidity. Interestingly, Bitcoin's price action is currently tracking the inverse of Japanese bond yields with remarkable precision. As Japanese yields skyrocket, signaling a tightening of global liquidity, Bitcoin sells off. This makes sense in a liquidity crisis. Bitcoin is a speculative asset. When investors need to raise cash to meet margin calls or pay off debts, they sell what they can, not necessarily what they want to. The fact that Bitcoin and Ethereum have shown negative or lackluster returns over the last year compared to the volatility involved further suggests that the easy money era that fueled their rise is pausing. The convergence of these factors creates a dangerous feedback loop. The fear of the Japanese carry trade unwinding leads to selling in U.S. markets. This selling reduces the value of collateral that institutions use to secure loans. As collateral values fall, banks pull credit lines, leading to crisis in private credit. This forces more selling to raise cash, which further depresses prices. It is a classic liquidity spiral, and the trigger resides in Tokyo. While Japan provided the spark, we cannot ignore the pile of dry tinder we've accumulated right here at home regarding our fiscal health and the economic fallout. While Japan's debt crisis acts as the spark, the United States has accumulated a massive pile of dry tinder in the form of its own fiscal health. The United States national debt has ballooned to over $38 trillion, with a trajectory heading toward $50 trillion. For decades, the sheer size of this debt was ignored because interest rates were historically low. But as the Federal Reserve raised rates to fight domestic inflation, and as Japanese demand for treasuries evaporates, the cost of servicing this debt has exploded. Today, the interest alone on United States debt is over $1 trillion a year. To put that into perspective, the United States government now spends more on interest payments to bondholders than it spends on its entire annual defense budget. This creates a vicious cycle. To pay the interest, the government must borrow more, which increases the debt pile, which increases the interest payments. This is happening at a time when the largest foreign holder of U.S. debt, Japan, with roughly $1.2 trillion in treasuries, is stepping away. Japan has been a reliable buyer for decades because its own domestic bonds paid nothing. But now that Japanese bonds offer a yield, and when one factors in the cost of hedging the currency, US Treasuries no longer make mathematical sense for Japanese investors. As they stop buying, or worse, start selling, the United States must find new buyers. To attract new buyers, the US Treasury must offer higher interest rates. This is why we are seeing long-term bond yields in the U.S. rise. Even as the Federal Reserve cuts short-term rates, the impact of these rising yields filters down directly to the American consumer. United States Treasury yields are the benchmark for almost all consumer debt. When Treasury yields rise, mortgage rates rise, credit card interest rates rise, auto loan rates rise. The cost of living is being squeezed from every angle. The housing market is the most visible victim of this dynamic. The American dream of the white picket fence, 2 cars, and stability is becoming a statistical impossibility for a large swath of the population. The affordability index is at its worst level in history. The average age of a first-time homebuyer has risen dramatically, now hovering around 50 years old in some demographics. For those under the age of 40, the prospect of home ownership is slipping away, replaced by a reality of perpetual renting. This is exacerbated by proposals like 50-year mortgages, which do not solve the affordability crisis, but rather shackle buyers with debt for the entirety of their adult lives. The retirement crisis is equally acute. For the generation currently entering retirement, the math has broken. The biggest fear among seniors today is no longer passing away. It is running out the debt trap of funds before they pass away. With advances in modern medicine, people are living longer, often into their 90s or hundreds. This longevity creates a financial strain that the traditional retirement model was not built to withstand.